The Fed doesn't set gold prices, but it can move them fast. Most Fed talk around gold is built on myths. The Fed doesn't set gold, and higher rates don't automatically mean lower gold, because what matters is what those rates do to real returns and the dollar. Big swings often happen on decision day because traders reposition at once, not because the announcement is magic. Hawkish always crushes gold, fails in risk-off moments. And gold isn't a stock, it's priced like money with emotion attached. The Fed affects gold through a few transmission channels, and they all run through incentives. Real yields, meaning yields after inflation, set the opportunity cost of holding a metal that pays no interest. The dollar matters too, because gold is priced globally in dollars, so a stronger dollar can create pricing pressure. Cuts can boost liquidity and risk appetite, while stress can spike safe haven demand. Fed weeks raise volatility, and inflation narratives can change before the data does. If you remember one metric, make it real rates, not the headline Fed funds rate. The nominal rate is what you hear on TV, but the real rate is what you earn after inflation eats purchasing power. Gold tends to track real yields more closely than it tracks the Fed's headline moves, because investors compare gold to safe, interest-bearing alternatives. Inflation expectations can diverge from current inflation, which is why gold can rise even as rates rise. Watch the direction of TIPS yields as a clean, real rate signal. Markets don't move on what the Fed does, they move on what the Fed does versus what was expected. A no-change meeting can still move gold if the statement or press conference shifts forward guidance. The balance sheet is another lever. Shrinking it can tighten conditions, while expanding it can loosen them, even without changing rates. Real rates still do most of the heavy lifting, but your vehicle matters. Physical gold, ETFs, and miners can react differently. Use Fed weeks for planned entries, not emotional chasing. A practical way to follow the Fed without getting whipsawed is to track a few trends, not headlines. Check real yields weekly, watch the dollar's direction, and keep an eye on inflation expectations so you know what the market is pricing in. Then define gold's job first: hedge, diversification, or long-term store of value, because that sets how you judge results. Write time horizon rules before you buy. And avoid meeting-to-meeting trades. Most people lose on the noise, not the trend. Real yields, especially TIPS yield direction, often explain gold moves better than the Fed headline rate. The smart investor matches you to the right way to get gold exposure and shows the real dollar cost differences between options for your goals. Free, takes about 3 minutes, and the link is in the description.